The headlines have been saying the same thing for 20 years. Estonia, the digital republic, the Baltic tiger, the country that reinvented government. It is a story so perfectly packaged that journalists copy it from each other without checking. And why would they? The press releases are polished, the spokespeople are fluent in English, and the whole thing photographs beautifully. Estonia's nominal GDP sits at roughly $51.6 billion in 2026, and its GDP per capita of around $37,700 puts it comfortably in the top tier of income rankings. Those numbers get quoted everywhere. What does not get quoted is what sits underneath them. Over 20% of the population lives below the poverty line, defined as income under $807 a month. Nearly 1 in 4 Estonians is at risk of poverty or social exclusion. That is not a number from a struggling Eastern European economy trying to find its footing. That is a number from a country that has been holding a global press conference about its own genius for 2 decades. Digital marketing is extraordinary. World class, honestly. Estonia understood before almost any other nation that if you brand your government as a startup, the financial press will treat you like a startup, meaning they will value the story, not the fundamentals. More than 1 in 3 Estonians say they cannot cope with an unexpected expense of €807. That is the actual ground truth. A population living paycheck to paycheck, inside a country the world calls a miracle. The facade is stunning. The wall behind it is crumbling. If you follow the news about Estonia, you have heard about e-Residency. It is the jewel in the crown. The idea that any entrepreneur anywhere on the planet can register a company in Estonia digitally, access European banking and operate globally from their laptop. Hundreds of headlines, dozens of TED Talk references, an entire national identity wrapped around a digital ID card. In 2024, e-Residents founded 4,818 new companies, roughly 400 new legal entities every single month. Over 121,600 foreign citizens from 185 countries have joined the program, and every 5th company created in Estonia last year had an e-resident among its founders. That sounds extraordinary. Here is what it actually means for Estonian workers. The entire e-residency program generated €63.6 million in taxes in 2024, with the government spending €7.5 million running it. 56 million net. For a country with a $51 billion economy, that is 0.1% of GDP. The companies are being registered in Estonia, but the founders, the employees, the economic activity, almost none of that is physically in Estonia. The program's own leadership now admits the strategy for 2026 to 2029 must shift to attracting companies that already have active businesses and are ready to employ people locally, because the current model has not delivered that. What e-Residency delivered was a perfect vessel for international capital to move through an EU-regulated jurisdiction with minimal friction. Tax-optimized, legally clean, and invisible to most scrutiny. The press called it innovation. The accountants called it something else. If this channel is giving you a new lens on how to read economic narratives, the subscribe button is right there. This story is only getting more specific. Spend a week in Tallinn, and you will believe the headlines. The old town is one of the most preserved medieval city centres in Europe. The tech district hums with co-working spaces, startup pitch nights, and very good coffee. The average tech salary is pulling well above the national mean. It feels prosperous, cosmopolitan, and alive. Then drive 4 hours east. Narva is Estonia's 3rd largest city, sitting on the Russian border with a population of roughly 52,000 people. Nearly 88% of residents are ethnic Russians. The digital revolution did not arrive in Narva. The startup ecosystem did not arrive in Narva. What arrived was the inflation that hit the entire country, the rising utility costs, the higher VAT and the wage stagnation. Monthly rents in Narva run around €740, compared to €595 to €919 for a mid-range apartment in Tallinn. But that gap understates the real divide because Tallinn's salaries are dramatically higher. A tech worker in Tallinn making 3 times a Narva factory worker's salary can absorb price increases. The factory worker cannot. Analysts at Coface explicitly flag persistent inequalities and poverty, especially in the predominantly Russian-speaking eastern regions, as a core structural risk in the Estonian economy. This is the hidden cost of building a digital-first economy in a small country with deep geographic and ethnic fault lines. You get Tallinn, and you get everything that Tallinn is not. The government counts both, the brand only shows you one. Estonia will tell you it has a flat income tax rate of 22%. It presents this as evidence of fiscal discipline, simplicity, and business-friendly governance. It is the poster child for the flat tax model. What it never mentions is what happened when the real world stress-tested that model. In 2022, Estonia's inflation rate spiked to 19.4%. The Eurozone average at that time was 9.6%. It peaked at 25.2% in August 2022, the fastest price increase in Estonia in more than 30 years. A flat tax does not care whether you earn €800 a month or 8,000. When cooking oil doubles in price, a warehouse worker and a startup founder pay the same price for it. The flat tax offers zero cushion, zero progressivity, and zero ability to protect purchasing power for the people at the bottom of the income ladder. Estonia's median income sits around €1,500 a month. Sweden's median is approximately €3,200. Yet for many essential goods, prices in Estonia are nearly the same or even higher. A double cheeseburger in Stockholm costs less than one in Tallinn when measured against local purchasing power. The poverty rate stood at 20.2% in 2023. The at-risk of poverty or social exclusion rate hit 24.2%, exceeding the EU average of 21.4%. The inflation crisis did not arrive randomly. It hit a population that a flat tax had already left with no financial shock absorbers. The digital miracle had no safety net built into it. Estonia's startup story is real, and it is genuinely impressive at the level of individual companies. Skype, Bolt, Wise, Pipedrive. For a country of 1.4 million people, that is a remarkable output. But a handful of unicorns is not an economy. It is a highlight reel. The deeper problem is what the economy became addicted to sustain those stories: cheap foreign capital, low interest rates, and a global appetite for growth at any cost tech investing. When that environment ended, the exposure became visible. European venture capital funds raised just €9 billion in 2025, the lowest level in the past decade. Estonia's own startup investment community publicly acknowledged that the key challenge ahead is attracting foreign fund of funds investors back into Estonian venture capital. By 2023, Estonia had attracted $40.5 billion in total investment stock, but 30% of that was in the financial sector and 18% in real estate. Only 16% went to science and technology. The capital was never as productively invested in the real economy as the branding suggested. A large portion of what flowed in was financial sector money and property speculation, not industrial production, not manufacturing, not exports of physical goods. When global interest rates rose and cheap capital dried up, there was no deep industrial base to fall back on. Estonia's foreign direct investment swung to a fall of 6.4% of GDP in the fourth quarter of 2024. The money was already starting to leave before anyone publicly acknowledged the structural problem. The people who cannot afford Tallinn are the people who built it. The nurses, the teachers, the bus drivers, the warehouse workers, the people who stock shelves, repair pipes, and clean offices. They are watching their city get priced around them in real time by people who arrived with salaries denominated in a completely different economic reality. Tallinn housing prices have risen roughly 120 to 160% in nominal terms over the past decade, with a further 4% rise year on year by early 2026. The average Estonian monthly gross wage is €2,011. In premium areas of Tallinn, purchasing just 1 square metre of property requires nearly 3 full months of that salary. Most Estonian workers are increasingly priced out of prime residential areas, and the income-to-housing price ratio has deteriorated substantially compared to historical norms. In 2024 alone, apartment prices rose by over 11% in Estonia, even as demand softened. Supply is not keeping up, construction is slowing, and the city continues to attract high-earning tech workers and international investors who do not need Estonian wages to afford Estonian property. Foreign direct investment heavily targets high-value real estate in Tallinn, And as more international companies establish offices in the city, the demand for premium accommodation keeps rising. The winner in this story is the landlord class and the international real estate investor. The loser is the local worker who has nowhere left to go in their own capital city. Here is the part of the story that never makes it into the branding decks. Estonia's government loves to project an image of lean, self-sufficient digital governance. No waste, no bureaucracy, no handouts, just clean code and flat taxes. But pull back the curtain on the infrastructure, and a different picture appears. Estonia has received EU fund allocations totaling €4.4 billion, roughly 11% of its 2024 GDP, over the 2021 to 2027 period under the Recovery and Resilience Facility and Cohesion Funds. Incoming EU structural funds of up to 1.8% of GDP per year are supporting Estonia's public investment and domestic demand. Those funds are going into energy efficiency, transport and digital transition. In other words, the physical and social infrastructure that Estonia's population actually depends on is being maintained significantly by Brussels, not Tallinn. The EU's Recovery and Resilience Facility alone allocated €953 million to Estonia, with €573 million still available until August 2026, targeting energy, transport, health, and defence sectors. A country that markets itself as a self-built digital republic is running on European structural transfers that most of its admirers do not know exist. That is not a criticism of accepting EU funds. Every member state does it. It is a criticism of the myth that Estonia built its miracle alone. Every serious investor who looks at Estonia eventually does the same calculation. The opportunity is real. The talent is real. The infrastructure is real. And then they look at the map. Estonia shares a border with Russia. It spent 50 years under Soviet occupation. It is a NATO member, which provides a formal security guarantee, but formal guarantees and investor psychology are different things. Estonia's own largest entrepreneurs now openly confirm the country is losing its attractiveness for external capital. The border factor, being adjacent to a hostile state in the fourth year of the Ukraine war, creates a psychological and financial barrier. Western capital is now actively bypassing the Eastern Baltic for long-term physical investments. The number of foreign direct investment filings under Estonia's new screening regime remained modest in its first full year of 2024, partly due to decreased capital flows into Estonia and the difficult geopolitical situation in the region. The OECD now explicitly lists regional geopolitical tensions as a primary downward risk to Estonia's 2026 growth projections. The tech sector can weather this because code travels and startups can relocate, but a factory cannot relocate, a logistics hub cannot relocate, a long-term manufacturing investment cannot relocate, and so the geopolitical discount applies precisely to the sectors Estonia most needs, to build an economy beyond the App Store. Everything we have covered points to the same place, an economy built on a brilliant story, held up by foreign capital that is already retreating, EU transfers that are finite, a domestic population being squeezed from every direction, and a geography that makes deep long-term investment a hard sell. The Estonian economy contracted for 3 consecutive years, before posting a modest 0.6% recovery in 2025. Even that recovery was disrupted in early 2026 by renewed geopolitical tension in the Middle East, pushing inflation projections back to 4.4% for the year. The government deficit is now projected to reach 4.5% of GDP in 2026 and 4.8% in 2027, driven by spending increases that Estonia cannot fund without further borrowing or European support. The triggers are already pulling. A global tech slowdown cuts startup valuations and dries up the venture capital that funds the Tallinn ecosystem. An EU funding cycle ends after 2027. And the structural transfers that quietly maintain Estonian infrastructure shrink. A prolonged conflict on the eastern border keeps long-term industrial capital away for another decade. None of these are predictions, they are already in motion. The Estonia story is not false. The digital innovation is real, the governance is genuinely impressive, and the engineers are world-class. What is false is the completeness of the story. The headline version leaves out the 20% poverty rate, the hollowed-out eastern towns, the inflation that destroyed working-class savings, and the subsidy machine humming quietly behind the press releases. Stop reading the app interface. Start watching where the capital actually moves. If this kind of analysis cuts through the noise for you, subscribe and share this with someone who still thinks the Baltic tiger story ends well. The next video goes somewhere the financial press will not follow.